Hi everyone. Today I am speaking with Sam Tremethick, who is the Chief Partnership Insurance Officer for AIA. AIA being the world's largest life insurance company. Here at Ngara & Co, we specialise in risk management, so we're looking at wealth, and one of those, I guess, the key pieces of risk management is insurance. So really happy to have you here. Thank you so much for joining us.
Oh, Carly, thanks for being here, and hopefully the listeners are still tuned in, because normally when they hear life insurance, people sort of glaze over and turn off, but hopefully we can make it interesting for them today.
I'm sure we can. So, most of our clients, most of my clients would have been introduced to insurance through a brand name called Sovereign. Some of them may have gone through their bank, ASB, for example. So can you explain to us, now they're getting these letters with red branding, AIA, what happened?
So going back a while now, it's sort of September 2017, AIA announced the acquisition of Sovereign Insurance here in New Zealand and also ComInsure in Australia. AIA had been operating in New Zealand for 40 years prior to that, but we're very much a small niche player. And this, acquisition of the Sovereign business here in New Zealand was pretty transformative. It really gave us the scale to do some pretty cool things. And since then, hopefully some of your clients have seen, we've really tried to change the way insurance is manufactured and more importantly, sold within New Zealand.
So when we're talking about insurance strategies, we are looking at putting a bit of money in place to fund negative health events so that you're not having to dip into investments and whatnot. Wealth, when we're talking in that sense, is obviously about money. But Sam, what does wealth mean to you?
What do I define wealth as is really that abundance of health. And I know it sounds a bit cliche, but what's important to me is increasing my health span, not necessarily my lifespan. And there's all sorts of studies around and, the 7 signs of wellness and whatever else. And look, it's each to their own, but for me, it's pretty simple. I can't do 7. I've got 4. It's friends, family, fitness and fun. And if I can sort of fill those 4 buckets and make sure that I've got, it's timing each and qualitying each, then I know my mental wellness is better. I know my physical wellness is better. And lo and behold, my financial wealth is quite often better as well, because I'm only doing a job that I love. It gives me fun. I love going exploring, traveling the world. So that ticks off the fun bucket, but it's also a chance to reconnect with the family. So it's ticking the family one. I go to the gym in the morning with a group of mates. It's ticking the fitness, but it's also ticking the friendship piece. So for me, just getting the balance across those 4 things is really what's important to me. And that's how I measure success. Yeah. I know I'm hugely unsuccessful if I don't have those buckets filled.
Yeah, and that's interesting, slightly going off topic, but in Te Ao Māori, they have a very similar structure. It's called the House of 4 Walls, and those 4 pieces that you've just spoken about are the 4 walls in the Māori worldview of wellness, and that's, if either of those is not sort of supporting the roof, then
Yeah, for me it's balance. And look, I'm not speaking gospel here as I'm perfect at it. It takes time and it takes effort and it takes focus, because you can go down a path of focusing purely on one thing and it often affects something else. And when you don't have that balance, things just don't work.
Exactly. I've been focusing on fun and food and now my pants are a little bit tight.
That could be an issue.
When we've started the insurance journey with people, we are looking at things like we're getting them to fill in a lot of paperwork, we're asking a lot of questions. A lot of the stuff's online now, but we ask a lot of medical questions. So that's obviously to help you as an insurer decide whether you want to take this person on, I guess, as a client or a risk. This process we call underwriting. So you've got to go through, what kind of health history do you have? What do you do for work? All of that type of thing. Now, you can do this through a bank. You can do this online. You can do this through an advisor. Why is it so important, or why does the insurance company need to know this health information to such a deep level?
Awesome question. Let's just take a step back and probably let's define what insurance is and understand, how insurance companies operate. Please. So essentially what we want to do is we want to get a pool of, in this case, people. So a pool of people where we can spread the the individual risk over a number of people. For a company to make profit, it means that we're receiving more premiums than the amount of claims that we pay out. So that's defined essentially as underwriting profit. And so underwriting in its nature is to connect a whole group of people together, a whole pool of people. You need good product at a reasonable price. So how do we keep that base level price as cheap as possible? It's making sure that we're managing the individual risks. So when we're asking questions of you during the application process, it's to assess you as an individual before we put you into this pool. And so that it's fair and so that we spread the cost equitably, those people with a higher risk will obviously receive a loading or an exclusion, which means that they might pay a slightly higher premium than those that don't. Now, the obvious one there is smoking. So those that are smokers will pay a higher premium than a non-smoker. But it also relates to age. So if you're older, you're at a greater risk of potentially claiming on your insurance. So you'll pay a higher premium than those that are younger. So we can spread that risk at an individual level, but keeping that base rate for everyone at the lowest price point possible. So there are insurance products that don't require underwriting. And they're great, and don't get me wrong, there's a place for them. But because you can't assess that risk, that base rate is generally higher. So you're always going to start off with a much higher premium because you can't determine what that individual risk is. The other part to that, and probably the crucial part to that, is that we ask a lot of questions up front and we ask for a lot of disclosure up front to ultimately make the claims process easier. We want to make sure that the pricing is accurate to your individual circumstances, but more importantly, by doing that, we can keep the price cheaper for everyone and then bring more people in. The more people we have in, the more risk we can spread, and then obviously it's cheaper and cheaper again. To be honest, that's insurance 101 in the sense that that's why we do it. Understand that it can be frustrating at times, and the more cover you want, quite often the more questions we ask as well, because we want to really make sure that we understand that risk profile of the individual.
I guess, at the end of the day, when you're buying insurance, you're hoping that you're buying a claim. So by doing all of this underwriting up front, all these medical questionnaires, like you've said, you've actually put yourself in a really good position to receive a claim, and the amount of claims that have been paid out in 1 year, it's phenomenal.
Yeah, look, it is huge. Look, I think the perfect insurance policy, though, is one that you never claim on.
Yes.
Hopefully that means you don't get sick and whatnot. But absolutely. Absolutely. You want certainty, and it is a promissory note. Insurance by its nature. You're buying something that in the future, if something goes wrong, you'll get a claim paid. Yeah. And so being transparent, being honest and upfront, making sure you're disclosing those medical conditions, it just takes any of the grey area away come claim time.
But I guess that's the whole point of using an advisor. They can kind of help you through that process. It's not like an online service that you kind of expected to navigate yourself.
Oh, look, without a doubt.
Yeah.
Right. And it's a lot of people don't intentionally non-disclose medical events. They just don't think about it when they're asked a question. So a good advisor will ask the question on the application, but then the follow-up question just to dig a little bit deeper.
And so we've been speaking about, what happens if you come to an insurance company, you've got a bit of stuff going on, you've got a bit of ill health or whatnot. AIA is doing something pretty cool around supporting people to make better decisions around their health, or if they have gone through this underwriting process and found some sort of concerning features in their health, AIA is doing something to help them address that. Can you tell me a little bit more about?
Yeah, look, absolutely. Look, we are trying to do something different. What we're trying to do is incentivise and reward people for making healthier choices. Okay. And we call this sort of shared value insurance. So if you engage and you make healthier choices, you're less likely to claim. If you're less likely to claim, that means we don't have to pay as many claims. Mm-hmm. We don't have to increase our premiums as much because we don't have to cover the claims cost, which means we can pass cheaper premiums on to you. Mm. This is a sort of a virtuous cycle in the sense of it's a win-win for everyone. Hence the shared value. So we do this with a program called AA Vitality. So it's very much a science-backed wellness program. You do healthy things. You track your exercise. You track your sleep. You eat better, etc., etc. earn points,
Yep.
and then you can redeem these points, whether it's discounts at Les Mills Gym, whether it's Air Points vouchers, whether it's Countdown vouchers, whether it's Apple vouchers, etc. We reward you along the way. So it's very much incentivizing healthy choices to hopefully prevent claims from happening.
Cool.
So this is where AA Vitality comes in. So how can we use behavioural economics to actually incentivise you and motivate you to do something? So with AA Vitality, we introduced the Apple Watch benefit. It's been going for about a year and 6,000 people have already taken it up. And so that's pretty cool. And what it is that we'll give you an Apple Watch on a 24-month payment plan, but you can have it free today. But here's the kicker. This is the thing that makes it interesting. If you do a certain amount of activity per month, AIA will pay that monthly instalment of your watch.
Okay.
If you don't do that activity, you have to pay the monthly instalment. And so from a behavioural economics piece, it's all around loss aversion. So what people value is not actually having to pay for their watch.
Yeah. That's motivating enough.
So they want to do their exercise so they don't have to pay that monthly instalment. They want that watch for free.
Yes.
And they value, essentially it's only $27 a month, but they value the loss more than the actual amounts.
Yeah.
And so what we've proven just with the 6,000 people that have participated in the program so far is that they're 35% more active from before they have the watch to after they have the watch.
Yeah.
So it just naturally encourages people to do it because we all know we have to exercise, but when you actually have a financial component to it, you're actually definitely going to do it.
Yeah.
I don't want to pay for it.
Carrot
We hear
mustard.
stories about people going for a walk around the block, at 8 o'clock on a Sunday night because they've got to get their weekly target. Well, that's, it might be dangerous in some areas, but that's the kind of stuff that we want, right? We want people moving. And so that's just an example of one of the many sort of behavioural economics pieces that are involved in this program.
Awesome. Cool. Well, I guess that's what my next question was going to sort of head towards, because, a lot of people, you're looking through your budget, especially during these times at the minute, and you're going, oh my goodness, like what can I get rid of? And a lot of people see insurance as something that's one of these big grudge purchases, such a leech on my budget. But even leeches have a function. So when it comes to insurance and I guess adding that value back, the Vitality program sounds like it's got some good benefits there.
Yeah, look, and coming back to my point, the perfect insurance policy is something you never claim on, right? And that's because then nothing's gone wrong.
Yeah.
But absolutely, when you're looking at your weekly, monthly, spending budget and you're looking at your discretionary items, it's quite easy to put insurance into that discretionary bucket. Now, I'll argue black and blue that it's not a discretionary item, that it's something that is incredibly important
Absolutely.
to your family and to you as an individual. But, I can understand why people do that. Historically, your engagement with an insurance company was an annual letter that told you what your premium was and a bill for you to pay. And in most instances, because you got older that year, that premium's gone up a little bit from the year before, and it's not a very nice thing. So every time you get that bill, you think, do I have to pay this or not? Yeah. As I said, changing the model from just being a bill to something that you can get tangible value out of on a regular basis.
And I guess have some effect on the premium yourself by being proactive and whatnot.
Absolutely. There's a discount on your premium. So if you engage with Vitality, and we want people to, because it's about making people healthier, we'll actually give you a discount on your premiums. If you reach platinum status, and you do for a number of years, you can actually have a 20% premium discount. So you can control really the premium that you pay. So if I don't engage, I'm paying on average, $2,000 worth of premium a year. If I do engage, I'm paying $1,600. So, there's a $400 savings plus all the partner benefits that you get from it. So I reckon it's pretty cool.
Yeah. So, touching on a premium, as you said, every year you get a letter or you get a email from me or a phone call from me, and I'm saying to you, yep, once again, your premiums are going up. What's inside a premium? How does an insurance company decide on how much to charge a person?
There's the insurance component itself. So as I said, we have to cover we have to ensure that we've got enough money from the collective pool of premiums to pay the claims costs. And we can do that in a number of different ways. We can take the risk on ourselves. We actually reinsure to what we call reinsurers, where they actually then create bigger pools of clients so they can spread risk further, so they can take on some of that more risk, and we pay them a premium. So it's sort of that way. We also have our administration costs, and we also have a whole raft of costs that build up the premium. But, one of the critical pieces for us that drives potential premium increases, well, there's two. There's one which is lapsation, so those people that decide to cancel. So if you're having a whole lot of people cancel their cover, unfortunately that means other people in the pool have to increase the amount that they pay, or claims. So if we have a massive increase in claims, then of course that's going to impact the premium rates that we have to collect.
Mm-hmm. And I guess we've kind of touched on this as well, but, when we talk about loadings, a few of us are a little bit too short for our weight, or you, like me, you're a fan of the coffee and party mix diet. With Vitality, can you use these, I guess, benefits to kind of manage that type of aspect that's inside the premium, those individualised increases in premium due to your structure?
Due to structure, I like that. You're spot on. So, coming back to that underwriting piece, there are a number of things that determine loadings, exclusions, etc. One of them is gender. Males are higher risk than females, for example. Smoker status and look, BMI, body mass index, is another. And the reason we charge more for people that are too short for their weight is we know that when you're overweight, you're actually at a higher risk of a lot of high blood pressure, whether it's cholesterol, whether it's you're actually more susceptible to certain types of cancer, cardiac, heart disease, etc. So there's a natural loading, and all insurers will charge a loading at some point based on a BMI index. Where we're different is obviously we want people to engage in healthier activities. So if we can get people, and look, it's personal choice, but if you want to engage in the AIA Vitality program, we're fairly confident that you can become healthier from it. It is around the principles of moving well, eating well, sleeping well, planning well, etc. So if you're sort of ticking off all those elements, then we hope that there's a better health outcome and health conditions. So if you engage, you lose weight, then we're happy to review those loadings and exclusions. We want people to pay premiums that are appropriate to the risk that they have.
Okay, so we've recently seen pretty hefty increases along the premiums for trauma products. So those are the products that would pay out a lump sum if you have a heart attack, if you are diagnosed with cancer, stroke, all of those types of things. Since these conditions might be getting diagnosed earlier due to medical advancement, everything like that, has that had an impact on your claims, or have you seen that reflected in claims?
Yeah, look, there's a few bits to this. So let me just stick on the track of Vitality first and talk about, again, why the Vitality program is really important. One of the aspects of Vitality is you can accumulate points by having an annual checkup at your local chemist. Blood pressure, cholesterol, height, weight, etc. Just a pretty simple health check, but it's something that, speaking as a male, we just don't do. We don't go to the doctor. We don't have checkups. So the purpose of that checkup and that annual checkup, we make it free. We make it that you can accumulate a lot of points from it. And the reason we do it is early identification of illnesses. And what we know is that if we identify illnesses early, there's a much better cure rate in most cases, and we can address a claim far earlier than when it gets genuinely serious. Now, Vitality in New Zealand's only been around for 3 years, so we're a bit early to see a trend, but what we're acutely aware of is individual circumstances. We've clients have shared stories with us that they've taken advantage of. We have a partnership with MoleMap where you can get discounted mole maps, where we've had clients that have gone in, taken advantage of the 50% discount, and lo and behold, they've identified early stage melanomas. Wow. That they've been able to address and have removed before it's become something serious. Similarly, with some of the health checks, we've had people that have gone in unknowingly, all of a sudden realised and identified that they've got high blood pressure that they weren't ever aware of, and so that they can treat it early. And so it doesn't become a claim. So that's really important to us. But the thing with Vitality, although we can't prove it here in New Zealand yet, what we do know is that it's a global program. It's got 20 million members worldwide, and in South Africa, where it originated, it's been going for 20 years. So there's longitudinal studies that we can tell those people that actively engage in the program versus those that don't. So the stat that I love is that the difference between Vitality members and non-Vitality members, there's a 10% reduction in hospitalisation rate. Oh. So just because you're a member, there's 10% less chance that you're going to be hospitalised. But the really cool thing is that there's actually a 25% reduction in the duration that you're in hospital. So not only less people going to hospital, when a Vitality member does go, they're actually recovering faster and spending 25% less time. The other one, digging deeper again, from a cardiovascular position, so a heart attack or heart disease, in South Africa, you're 32% less likely to claim on a cardiovascular condition if you're a Vitality member to a non-Vitality member. Mm. So these are really tangible numbers. And look, to prove this point even more, South Africa, again, if the difference on a lifespan, it's 14 years. So a Vitality member, on average, is living 14 years longer than a non-Vitality member. And this is mind-blowing, powerful stuff. So again, you're absolutely right. Claims are becoming more frequent, but there is so much we can do on the preventative side to actually reduce that claim outcome. So for us, that's really what we're doing to counter some of these higher claim costs that are coming through.
Cool. And I mean, when we're looking at time for us is around wealth building, I guess that time when we're seeing a reduction of time in hospital, a reduction of time outside of, generating income, that is really powerful for, our clients, my clients and listeners, being able to get back, not having to self-fund through that time is huge. So massive benefit there. Yeah,
and huge. And look, AA has released a study, and jump on the website and pull the report. It's a great report called 5590. Okay. What does 5590 mean? Mm-hmm. Well, there's 5 modifiable behaviours: physical activity, nutrition, smoking, excess alcohol, and the way you're engaged with the environment are contributing factors to 5 non-communicable diseases. And what I mean by that is they're non-contagious diseases. So it's lifestyle diseases. So, it's cancer, diabetes, respiratory disease, cardiovascular disease, and poor mental health. And they actually attribute to 90% of the premature deaths in New Zealand.
And a lot of the claims, I'm assuming from our experience anyway, yeah.
So we know that if we can modify those 5 behaviours, so if we can get people moving well, if we can get people to stop smoking, to stop excessive drinking, to engage with their environment, and what really that is around better mental health and ensuring that you're actually taking the time to stop, to slow down, to fill those 4 buckets or the 7 buckets or whatever's important to you, and to sort of plan well, we're going to have a really big influence on those 5 diseases that essentially cause 90% of premature death in New Zealand.
So when we're talking to clients, insurance sometimes has quite an emotional tie, for the majority of clients, I would say. It's to protect family, it's to protect debt, mortgages, whatnot. But there's also another side of our clients' listenership that don't have any of that. They don't have a family, they don't have any debt, or they might be debt-free, or the dependents are no longer dependent. We then look at insurance as more as a structured piece in a larger risk management plan. And what I mean by that is that we use the funding that would be provided by insurance to hedge against some of the volatility that's involved with investing. So if you were to come up against a negative health event, having to withdraw those funds from an investment at a suboptimal time, and sort of realise all of that loss potentially, insurance can be a piece of that puzzle. So for you, Sam, save your money in a rainy day account or look at insurance? Which option would you be looking at here?
Oh, insurance. No, but I'm not. Of course, I'm going to say that because I work for an insurance company. But the answer isn't binary, right? It is both the right at different stages of your life. And you know what I mean by that, and you've touched on it in some respects with the question is, if I'm a 35-year-old individual, I wish I was a 35-year-old individual, but if I was a 35-year-old person with the intention of working until the age of 65, you know, I want to protect the next 30 years of income generation. Now, that's going to be a lot cheaper to do via an insurance policy than it is going to be doing via savings. Now, if I'm a 60-year-old individual expecting to work until I'm 65 and I'm only protecting 5 years of income, then that equation may tip and it may be more worthwhile to look at that from a savings perspective. But then, you know, I'm at a higher risk at age 60 of being diagnosed with cancer. So my interest might be to look at an insurance policy that just covers me for cancer care, which is going to be cheaper, but it covers pharmac and non-pharmac drugs and treatment of cancer. So I'm saving money on my insurance policy. I'm not necessarily protecting my income, but I am, as you say, protecting that risk of, you know, having to dip into my savings to cover, you know, a specific illness. So rather than answer the question of, you know, insurance versus rainy day account, for me, the question is, or a better question is advice or not advice. And I would advocate for advice the whole time because you have to, you know, a good advisor will understand your circumstances and be able to recommend a solution, whether that's an insurance product or a savings product or an investment product that meets the needs that you have. And a good advisor will then review your situation on a regular basis. Because, coming back to that point, life is complex and life changes. And so then the need for having different financial positions, whether it be insurance, investment, KiwiSaver, whatever it might be, is always going to shift and change. So, you know, I think rather than looking at it as, you know, insurance versus savings, I think it's advice or not advice, and it's advice all the way for me.
So every year we're getting a letter, your premiums have gone up. What we have noticed this year is that our premiums are going up by a lot more than we used to. Is there anything that's sort of driving that, or what's behind that this year?
Yeah, so look, first and foremost, you know, we come from a very privileged position at AIA in the sense that we haven't done a base rate increase this year, and we don't intend to on all products other than our medical products. And to be quite honest, medical insurance is going to go up every year, and that's really because of the inflationary cost of medical delivery each year. So unfortunately, you can sort of bank that one. But there are, even though we haven't changed our base rates, there's obviously increases that come through. Yeah. So some of them is age related. So if you've got a stepped premium, every year you get older, that premium starts to increase. Coming back to that underwriting point, that every year you get older, unfortunately, you know, there's a greater chance that a medical event might occur. There's another component to that as well, which is inflation. And so one thing that, you know, a lot of insurance policies have built in an inflationary increase. And so whilst that's good, because the level of cover also goes up. So if you've got $100,000 worth of life cover in a 6% inflationary environment, that becomes $106,000. But then at the same time, your premiums will go up by that amount. You know, one thing I'll just let people know is that they can opt out of that. So they can keep the cover at the same level, and obviously that increase won't come through. And that's just something that, you know, whether speaking to you or speaking to their advisor, they can manage. And so we give them the option to opt out of that increase. You know, historically, we've actually been asking people as to whether they naturally want to top it up beyond inflation. Given where we are in an inflationary environment, we're giving people the chance to actually dial that back, right, just because we know that, you know, unfortunately, things are tight.
Yeah. Some questions I'm getting from clients this year in particular is, has COVID had any impact on premium increases?
Yeah, look, on a simple basis, no. We've seen a number of COVID claims come through, and they're in different parts, right? So, as New Zealand's largest insurer, we've had the bulk of COVID claims for death claims, which is terrible, right? And so, absolutely, we'll pay those like any other death claim. We've also seen an increase in redundancy claims, not so much this year, actually right at the start of the pandemic in going back to March, April 2020, no one knew what was going on. There was a lot of redundancies in various, industries, workforce, and that's where we saw a real spike in redundancy claims. That said, it's been pretty much level, and we haven't seen necessarily any real spike in claims because of COVID, which is very much different to other parts of the world. We've been very, very, very fortunate here in New Zealand. One thing that we have noticed, and one thing that doesn't keep us up at night, but we're conscious of, is actually because people have delayed some procedures, that they've delayed having mammograms, proactive, testing. What we're seeing is that we're seeing an increase now of more significant sort of trauma cancer events because they're probably being identified a couple of years later than what they could have, which is a tragedy in itself. So we'll continue to monitor that. As I said, we're not seeing the need to increase prices because of that yet, but it's very much a watching brief, and we'll continue to monitor that pretty closely.
And furthermore with COVID, a couple of questions that we do get is around my vaccine status. Does that have any impact on my premiums, the type of cover I'm going to be offered? Does it affect my cover at all?
No, look, the simple answer is no, but I just want to be clear on our position where we will encourage people to take vaccines, and that's not just the COVID vaccine, but it's vaccines of all nature. And again, coming back to Vitality, is you can actually earn points by getting a vaccine, and we'll give you points for taking a COVID vaccine. We'll give you points for taking a flu vaccine. We think, again, preventative medicine makes sense. We're comfortable with the COVID vaccine and think that it's better to have it than not have it, but we're also very respectful of people's choices. They don't have to have it. We're rewarding those people that do. We're not penalising those people that don't.
Great.
That is the correct answer, Sam.
Yeah. He passed.
Oh, thank goodness.
We can unlock the door.
That's cool. And how did you want to bring it to a landing?
Oh, I don't know.
You can just say that even. Let's bring this to a landing or whatever. Quite often I'll throw in a challenge, a call to action. You could reference something for people to check out. We talked quite a bit about Vitality. So
should I reference that 5590?
Report. Definitely. We can put if we can
extend a link. Yeah, that's fine. Yeah, definitely.
But just think about any whatever you want, really.
Okay. Yeah. Well, thank you so much, Sam, for coming in. I'm going to go download that 5590 report and tick off all the things I need to do this weekend. Just kidding. Thank you so much. We'll put a link up to that 5590 report just so people can sort of understand and unpack the things that they could be doing to
Yeah, look, and I think, the main call out here is that this is not about turning people into Superwoman and Superman. It's about taking small steps to become healthier and being proactive about it. And sometimes we need a little bit of a push, a little bit of encouragement. So, the program is about rewarding you for making those healthy choices. So hopefully I've convinced a few people that it's a good thing to do. And hopefully, with your discussions, with clients, that they understand insurance a bit more, but also what we're trying to do with Vitality. So thanks for the time.
That's great.
Today.
Thank you.